The U.S. economy is teetering on a precarious edge, and the Federal Reserve is poised to take dramatic action. With the labor market showing signs of cracking, the Fed is gearing up for a series of interest rate cuts that could reshape the financial landscape. But here's where it gets controversial. How deep will these cuts go, and will they be enough to stave off a potential downturn? Let's dive into the details. The Mariner S. Eccles Federal Reserve Board building in Washington, D.C. stands as the epicenter of these critical decisions. As policymakers prepare for their September 16-17 meeting, futures contracts suggest a 10% chance of a bold half percentage point rate cut. By January, the Fed's benchmark interest rate could plummet to 3.25% to 3.50%, marking a significant shift from its current 4.25% to 4.50% range. And this is the part most people miss. The Fed's move isn't just about numbers. It's a response to a labor market that's flashing warning signs. Last Friday's jobs report revealed a startling slowdown, with a mere 22,000 jobs added in August, a figure so weak it's hard to ignore. The unemployment rate ticked up to 4.3%, the highest since October 2021, and long-term unemployment is on the rise. More than a quarter of jobless Americans have been searching for work since February, a stark reminder of the challenges many face. Even more concerning, unemployment among Black Americans surged to 7.5%, highlighting the disproportionate impact of economic downturns on marginalized communities. Fed Chair Jerome Powell is walking a tightrope. While he's likely to approach the data cautiously, especially given the drop in immigration, the rising unemployment rate is sounding alarms. Powell has warned that even a slight increase in layoffs could send the jobless rate soaring. Employers are hiring slowly, and the labor market's fragility is now front and center for the Fed. Inflation data due next week will provide additional context, but for now, the focus is squarely on jobs. Bank of America economists argue that the August report should shift the Fed's priority from inflation concerns to addressing labor market weakness. They predict quarter percentage point cuts in September and December, with the policy rate dropping to 3.00% to 3.25% by late 2026. But here's the controversial twist. President Trump's relentless pressure on the Fed to slash rates has added a layer of political complexity. White House economic advisor Kevin Hassett suggests Friday's data could push the Fed toward a larger-than-expected cut this month, aligning with Trump's demands for lower borrowing costs. Hassett, a potential successor to Powell, whose term ends next May, is at the center of this debate. Is the Fed acting independently, or is it bowing to political pressure? That's a question sparking heated discussions. Financial markets remain skeptical of a half percentage point cut, pricing in only a 10% chance. Most bets are on a quarter percentage point reduction, with similar cuts expected at upcoming meetings. By January, there's a nearly 50-50 chance the benchmark rate will be a full percentage point lower than today. Not everyone agrees on the pace of action. Simon Dangor of Goldman Sachs Asset Management warns that the Fed might need to ease more aggressively than Powell's cautious Jackson Hole remarks suggested. Today's data suggests the risk of a faster pace of easing, he notes, adding fuel to the debate. As the Fed navigates this delicate balance, one thing is clear: the stakes are high. Will these rate cuts stabilize the labor market? Or are they too little, too late? And how will political pressures influence the Fed's decisions? These questions are ripe for discussion. What's your take? Do you think the Fed is making the right move, or is there a better approach? Let's hear your thoughts in the comments.